The FDIC, or Federal Deposit Insurance Corporation, is like a safety net for your money in the bank. Imagine if a bank goes out of business. Without FDIC, you could lose all the money in your account. But with FDIC, deposits are insured up to $250,000 per depositor per insured bank. For example, if you had $5,000 in a checking account, you would get that money back even if the bank fails. This system was created after the Great Depression to make people trust banks again. Monetary policy is like the thermostat for the economy. If the economy is too hot, high inflation, the central bank turns it down by raising interest rates or reducing the money supply. If the economy is too cold, slow growth or high unemployment, it turns it up by lowering interest rates or increasing the money supply. The goal is to keep inflation under control while helping people find jobs. In fractional reserve banking, banks only keep a small portion of deposits as reserves and lend out the rest. For example, if you deposit $1,000, the bank might keep $100 in reserves and lend $900 to someone else. This system allows more money to circulate in the economy but requires careful monitoring to ensure banks can handle withdrawals. Quantitative easing is when the central bank steps in to help the economy breathe. Imagine the economy as a sick patient. The central bank injects money into the economy by buying things like government bonds. This extra money makes it easier for businesses and people to borrow and spend, helping the economy recover. The Dodd-Frank Act is like a rulebook for banks after the 2008 financial crisis. It prevents risky behavior that caused the crisis, such as banks making bad loans or investing in things they didn't understand. Think of it as a way to make sure banks play fair and don't put everyone's money at risk again. The Federal Reserve's dual mandate is like having two jobs: keep prices stable, low inflation, and ensure people have jobs, low unemployment. For example, if prices are rising too fast, the Fed raises interest rates to slow things down. If too many people are unemployed, it lowers rates to encourage borrowing and spending. The Federal Open Market Committee, FOMC, is like the steering wheel of the economy. It decides whether to raise or lower interest rates or adjust the money supply. For example, if the economy is slowing down, the FOMC might lower rates to encourage spending and investment. The reserve requirement ensures that banks keep some money on hand to meet customer withdrawals. For example, if a bank receives $1,000 in deposits and the reserve requirement is 10%, it must keep $100 in reserve and can lend out $900. This prevents banks from running out of money if too many people withdraw at once.
Basel III is like a set of safety rules for banks. It ensures banks have enough money set aside to handle bad situations, like a sudden rush of withdrawals or an economic downturn. For example, it requires banks to keep more reserves so they don't collapse during a crisis. Restrictive monetary policy is like applying the brakes on the economy. If prices are rising too quickly, inflation, the central bank raises interest rates and reduces the money supply. This makes borrowing more expensive, slowing down spending, and cooling off inflation. The LCR ensures banks can survive short-term financial stress, like a sudden rush of withdrawals. Imagine you're a bank and customers demand $1 million in withdrawals tomorrow. The LCR makes sure you have enough liquid, easily accessible assets, like cash or government bonds, to meet that demand. If there's too much money in the economy, it's like too many people bidding on the same item at an auction. Prices go up. For example, if everyone has more money but the number of goods stays the same, inflation occurs because people are willing to pay more for the same things. The Volcker Rule is like a no-gambling sign for banks. It prevents them from making risky investments with their customers' money. For example, banks can't use your savings to bet on risky stocks or investments that could fail. When interest rates rise, borrowing becomes more expensive. This also affects bonds. If you have a bond that pays a lower interest rate than new bonds, your bond is worth less because investors prefer the new bonds with higher returns. A stress test checks if a bank can handle tough situations like a financial crisis. Imagine if unemployment rises and people can't repay loans. The test asks, will the bank survive or will it run out of money? Easing monetary policy is like pressing the gas pedal on the economy. The central bank lowers interest rates and increases the money supply to encourage borrowing and spending. It's often used during recessions to revive the economy. The Federal Reserve ensures the economy runs smoothly. It controls inflation, manages the money supply, and stabilizes the banking system. Think of it as the economy's manager, ensuring everything stays balanced. Quantitative tightening is the opposite of quantitative easing. The central bank pulls money out of the economy by selling securities, reducing the money supply. This helps control inflation but can also slow down the economy. The FDIC protects your bank deposits if the bank fails. For example, if you have $10,000 in a checking account and the bank goes bankrupt, the FDIC ensures you get your money back up to $250,000. What is a discount rate in monetary policy? The discount rate is the interest rate the central bank charges banks for loans. For example, if a bank needs money quickly, it borrows from the central bank at this rate. Lowering the discount rate makes borrowing cheaper and stimulates the economy. What is the relationship between inflation and unemployment in the short run? In the short run, inflation and unemployment often move in opposite directions. For example, if unemployment falls because more people are working, inflation might rise because they're spending more money. What is the impact of high inflation on the economy? High inflation makes everything more expensive. For example, if bread costs $1 today but $2 next year, your money buys less. It also erodes savings because the value of money decreases over time. What is the money multiplier effect? The money multiplier effect shows how banks create money. For example, if you deposit $1,000, the bank keeps $100 and lends $900. The $900 is deposited elsewhere, creating more money through loans. What is the role of open market operations? Open market operations involve the central bank buying or selling government bonds. For example, if the Fed buys bonds, it puts more money into the economy. If it sells bonds, it takes money out, controlling inflation. What does the Dodd-Frank Act aim to prevent? The Dodd-Frank Act prevents risky financial practices that caused the 2008 crisis. It requires banks to have more reserves and reduces the chance of another meltdown by enforcing strict rules. What is a key feature of fractional reserve banking? Fractional reserve banking allows banks to keep part of deposits as reserves and lend the rest. For example, if you deposit $1,000, the bank might keep $100 and lend $900 to others, multiplying the money in the economy. What does lender of last resort mean? As the lender of last resort, the central bank helps banks during financial crises. For example, if a bank runs out of money, the central bank lends funds to keep it afloat and prevent panic.